Okay, what do we have here, John? Talking to my producer. What's up? I know. Merck. Okay, let's talk about Merck. Okay, Lou in Hamilton, go ahead with your question.
Thanks very much. Thanks for taking my call. I really appreciate Mr. Burrows' perspective. I have a small amount of Merck, and recently, a couple of days ago, AbbVie came out with some information on I think it was a diabetes drug. In any case, Merck has fallen, and I'm wondering whether this is just a temporary blip or whether I should get out of the stock. Thank you. I'm going to hang up and listen.
So about 12 months ago, a lot of the big pharma companies came out of very long sideways consolidations, price consolidations they've been in, really going all the way back to 2000. And healthcare really has been a leading group over the course of this year. Pharma, of course, part of that group. Biotech, part of that group. And then you'd have to include medical devices and managed healthcare. So we like healthcare as a sector. There are several subgroups within there that we have exposure to. We don't own Merck currently. We own J&J and prefer that one. But having said that, we think that this sector is set to do very, very well in a relatively low inflation world, very predictable cash flows. I think a lot of the concerns around, Pat and Cliff have come and gone. And what you're left with are companies that are big distribution businesses, which should have some decent dividend growth as time goes along. So, the stock's been trading in a range of sort of 48 at the high end to 44 at the low end. It's been consolidating with the market. I think you stay with this one. I think that there's room to the upside.
All right, thanks, Louisa. As David mentioned, J&J is his preferred play in that area. Jim's in Pickering, Ontario with the next question. Go ahead, Jim.
Good afternoon, Mark and Dave. First of all, best of the season to you both.
You too,
Best
thank
to
you.
And my question is on REITs. And having said what you said off the top, we still need a little income and safe harbor. And where REITs, they did come back when they hinted at tapering about a month or two ago, the near 52-week lows, unlike banks that went to their all-time highs. So from here and in the near and longer term, what's your opinion on this? Thanks,
Okay.
Dave.
So, Jim, if we look at the sensitivities, of course, the thing that gets impacted the most by tapering and potentially higher rates is fixed income. And so, of course, the bond market's been a little bit sloppy. Now, I don't think you can make a case at this point that because we've gone from 1.5% to 2.8% on a 10-year U.S. government bond, that means we're going from 2.8 to 5. I do think we're going to be range bound in and around that 3% level for some time. So fixed income probably is not where we want to be. Next out on the curve would be the REITs, and the REITs have some dividend or distribution growth, a little bit of economic sensitivity, but they are tightly bound to interest rates. We would prefer to go one step further and be in the financials that actually can benefit from a rising rate environment, and in that camp we'll talk about an asset manager today, but banks, insurance companies, and so on. So I think that there continues to be some risk to the REITs depending on what happens with interest rates here because they are so tightly tied. I think within the REIT camp there are some that are a little better, maybe the more industrial oriented REITs that have a little bit more pricing power, a little bit more leverage to a better economy. But at this point I'd be a little cautious. The only caveat to that I would give you is that if given where we are in the year, we're midway through December, there has been some tax loss selling, I'm certain, going on through the course of this year of people who maybe were late entrants into the REIT space. You should see some pressure come off the REITs over the next few weeks as we get through the end of tax loss selling. I just think you might see more upside in the financials. So you probably don't get hurt too badly from here in the REITs, but maybe more upside in the financials if you believe we're in a little bit better environment.
Is there an industrial name that you could give us in the REIT sector?
I suppose I'd look at something like a Granite REIT, which is levered towards Magna's properties. They have lots of liquidity on their balance sheet, lots of ability to make some additional purchases, and an ability to grow their payout. So I think that's kind of attractive.
All right, that gives us a perfect segue into our next question. Here's Al. He's in Guelph, Ontario. Hi, Al.
Hi. Thank you very much for taking my call.
You're welcome.
David, my question is on Magna. I see Magna has dropped about 10% since early November. Do you think there's more downside, or is this a good time, a good entry point?
You know, Al, Magna's a company that we've recommended a couple times as top picks over the last year. And this is a big holding at Barometer in both the pools that we run in separate accounts. We really like the auto industry going forward. The age of the fleet is still very, very old, so there's a lot of replacement that has to take place. Magna did a wonderful job in making good acquisitions in the downturn, and they have lots of opportunity as this cycle matures to improve some of their margins, specifically in Europe. We think that there are legs in the auto cycle. So the stock came from, low 30s to where it is today. It's consolidating. I don't think that there's any reason to believe that this cycle is anywhere near done. So I think that really I wouldn't want to see it drop more than another 4 or 5% before I'd start to get a little more concerned. But in the short run, I think that this is more consolidation. Earnings estimates are being taken higher. They've got a wonderful balance sheet. They've got lots of opportunity to grow going forward. So I'd buy the stock here.
Granite REIT, you mentioned earlier, GRT.U. You mentioned the age of the fleet. We keep hearing it's about 11 years. I read a stat the other day that basically said, experts say, specialists say that may go up 20% by 2018 instead of coming down, which seems counterintuitive. Does that make any sense?
Well, I haven't seen that study, so I can't comment on it. But what I would say is we have a consumer that right now has record free cash flow. So if you think about it, debt servicing costs have been coming down for the last 3 years as they've been refinancing mortgages. Now food and energy prices are coming down. And when you look at how much free cash they have that's out there, now you've got an old fleet for cars, and we think that there's lots of replacement to take place going forward.
Okay, David, we'll take a pause here. We'll get back to questions right after this. Bank stocks on the docket. Stay tuned.